In the realm of dollars and dreams so sweet, there's a place to plant where ambitions meet. Comfortable profits, a name so grand. Invest your seed, let's watch it span.
To the idea of options in part 1. You learn that you could buy a call if you think the stock might go up, and you could buy a put if you think the stock might go down. But at this point, it's probably still a pretty abstract concept to grasp. Hang with us as we explain further. If you haven't already guessed, option contracts aren't actually physical pieces of paper. It's all done electronically. And you can buy or sell an option contract with your brokerage account within a few milliseconds at the click of your mouse, just like we can buy and sell stocks. What you are looking at is what we call an option chain. An option chain is simply just a list of all of the options that we can trade, and it also shows the price of each of these options. You can find an option chain in your trading platform and also a few different places on the web such as Yahoo Finance, Google Finance, etc. But the one we are looking at right now is in our trading platform that is provided by our brokerage firm that we use to trade. You can find a link to open a trading account with our favorite broker in the video description below. Again, what you're looking at right now is an option chain. It shows you all of the available options and the prices of each one. And most of your favorite companies and even stocks you might already be trading have options. And to see if a stock has options, all you have to do is type in the ticker symbol. And if it does have options, you will see the data listed below, and if it doesn't, it will say no options are available for this symbol. So let's just look at Apple stock options by typing in the ticker symbol AAPL. You can see there are many option contracts that we can trade, and there's actually so many that it might seem overwhelming at first glance. But don't get intimidated, we're going to explain this in the simplest way possible. Now, before we get into why these option prices are what they are, we're going to go over some very basic characteristics of options and also show you how to even read this option chain. First, we have to select our expiration. The expiration date, if you remember, is simply the date that the option contract will expire. So you can see there is a list of all of the available expirations, and what you are looking at is the actual date that they expire. And the number in the center here simply tells us how many days are left until that expiration date. So clicking on this expiration date, for example, would show you all of the options that expire on the 17th of July, 2020. And you can see here that that date is 11 days from now. And remember, we are still covering the very basics, so we're not yet going to go over which expiration you should be trading in. There are pros and cons to choosing different expiration dates, and you're going to learn about this later in the course. Right now, it's just important to get the basics down, so we're just going to choose the expiration date with 11 days to expiration. Once you click on the expiration date, you can see a whole list of options for that expiration. On the left side, you will see the call options that expire on this date, and on the right side, you will see the put options that expire on this date. For now, let's say we want to trade a call option with 11 days to expiration. Now we just have to choose our strike price. The strike prices of each option are listed vertically through the center of your screen. And just a side note, I don't know who decided how an option chain should be laid out, but for some reason they decided to list the strike prices in ascending order. And I would think it would be the opposite, where the higher strikes are higher on your screen, but it is what it is, and this is just something that you get used to. Now, just like with selecting an expiration, we also have to choose our strike price of the option we want to trade. And again, we aren't going to get into which strike you should be trading until later, but for now, let's just choose the 385 strike call option. Okay, so that's it. We know how to navigate the option chain to find a certain option. You can find a call option or put option with a certain expiration date and a certain strike price. But you can also see the price of each of these options. Just like stocks, options also have what is called a bid price and an ask price. And we're going to assume that you already know what the bid and ask price is. If you want to buy an asset, you're going to have to buy it at the ask price because that's where the sellers are. And if you want to sell an asset, you're going to have to sell it at the bid price because that's where the market is willing to buy it from you. Simple enough. Now let's take this option off to the side and we're going to talk about its pricing a little bit and what it would actually look like if you wanted to trade this option. Now, stocks trade in shares, but options trade in contracts. And one option contract is going to control 100 shares of stock. Let me explain. Remember, a call option gives us the right to buy stock at its strike price at a later date. Okay, so if we wanted the right to buy 100 shares of stock at a later date, then we would have to purchase one option contract. But if we wanted the right to buy 200 shares of stock at a later date, then we would have to purchase two contracts. So that's what we mean when we say one contract controls 100 shares of stock. So let's just say that we wanted to purchase one contract of this 385 strike call option. How much money would this actually cost us? Well, looking at this call option, you can see the bid price is $276 and the ask price is $281. So to buy this option, we would have to pay the ask price of $281. But here's the thing to understand. It's actually going to cost us $281 per contract. This is because since one option contract represents 100 shares, option prices will have a multiplier of 100. Now, we know this may seem confusing, and this is also just something that you get used to, and with practice, it will become second nature very quickly. One trick you can do is just think of these prices without the decimal point. If the price says 2.81, just remove the decimal and it's really going to cost you $281. Now remember, we mentioned that you don't actually have to trade stock and you can just simply trade the options. So what do we mean by this? Well, just like stock prices fluctuate and move around each day, option prices also fluctuate and move around each day. And in Chapter 3, you're going to learn about what causes option prices to fluctuate and why they might go up or down in price. But for this example, let's just say we bought one contract of this call option at $281. So we actually paid $281. And over the next week or so, let's say the options price goes from $281 up to $4. Now, just like trading any asset, we constantly have to make decisions about when to sell, and we could of course hold this and hope it goes higher, but let's assume that we have decided to sell this option and take our profit. So we close this position by selling the call option that we own at $4. So if we bought something for $281 and we sold it for $400, it's pretty clear that we made a profit of $119. Now let's look at one more example for practice. Instead of buying one contract of this call option at $281, let's say we wanted to purchase two contracts. The concept is the exact same here. We're just purchasing twice as many contracts. So if one contract cost us $281, then to find our cost of two contracts, we would simply just multiply that by 2. So two contracts would cost us $562. So now if the price of the option goes up and we can sell both of our contracts at $4, then that means we turned $562 into $800. So our profit would be $238. Now again, there are 3 factors that would cause an option's price to move up or down, resulting in a profit or loss. The first factor that causes this we've already vaguely touched on in Chapter 1, and that factor is the movement of the underlying stock price. The price of a call option will typically go up in value if a stock's price goes up, and the price of a put option will go up if a stock's price goes down. So to put it simply, if you buy a call option, you are betting that the underlying stock's price will go up. And if you buy a put option, you're betting that the underlying stock's price will go down. But remember, there are also 2 other factors that affect an option's price, and they are extremely important, so don't go buying options yet. You're going to learn about these in the next chapter. Now, before we move on, let's recap what you've learned in this chapter. You learned what an option chain is. This is simply what you'll look at to find all the listed options and the price quotes of each option. You can find an option chain in multiple places, but you're probably going to want to view options in your trading platform provided by your brokerage account. You also learned that option prices have a bid and ask price just like stocks. One option contract controls 100 shares of stock, and because of this, option prices have a multiplier of 100. Okay guys, now in the next chapter, we're going to go in pretty deep and you're going to learn the 3 factors that cause an options price to fluctuate. This is where it gets cool because then you will have the base knowledge you need that will allow you to start learning strategies to profit from option price fluctuations.